Hey guys, today we're talking about what gap insurance actually is, why it can be a lifesaver, and why buying it at the dealership is almost always a massive ripoff. Picture this, you just spent 5 hours at the dealership. You've chosen the car you like, you've haggled, you've test driven, you're exhausted, and you just want those keys to your new car. You negotiated things like the car's price and maybe the APR. So many variables. Actually, while doing research for this video, I found a very interesting article that lists the many ways in which a dealership can make money off you. Among other things, it explains the role of the dealership's finance and insurance manager. It says the following.
The dealership's F&I manager has three primary functions. Present the dealership's pitch for financing. It's worth listening because sometimes the interest rates are lower. But you also should arrange independent financing first. Then you'll be able to know for sure how good the deal is. The department's second function is to offer aftermarket products. Think extended warranties and theft protection packages. Ultimately, the third is to get a shopper's loan approved.
So going back to the day you purchased your new car, gear up and survive the finance office. Just when you think you're done with the car purchase and you're ready to sign paperwork, the sale is not final. The finance manager's office is a cold and scary place where the dealership can still push more products, such as extended warranties, like it says on the article, prepaid maintenance packages, and gap insurance. In my experience, most of these products are overpriced and or unnecessary. I only fell for an extended warranty the first time I ever bought my first new car, and never again, but that's for another video. The finance manager slides a piece of paper across the desk and says, you're going to want gap insurance. If you total this car tomorrow, it'll save you thousands. It sounds scary and it sounds necessary, but is it? Let's break it down. GAP stands for Warranted Asset Protection, but really it just covers the gap between what your car is worth and what you actually owe the bank. Here's the reality. Cars depreciate like crazy. The average price of a new car in early 2026 is over $49,000. Let's say you buy a brand new car for $50,000 to keep the math simple. The second you drive that vehicle off the lot, it loses value. A few months later, it might only be worth about $40,000. But especially in today's post-pandemic market, new vehicle prices are inflated, and in certain desirable models, it's hard to get below MSRP. Dealerships are more eager than ever to pile on add-ons to maximize profits on every vehicle driven off their lots. This means that an MSRP of $50,000 can easily turn into a $55,000 death on wheels driving off the dealership, which is worth over $15,000 less the minute it leaves the lot. So if you were to get in a bad accident and total that car, your regular auto insurance doesn't care that you owe $55,000 on that car. They will only write a check for the car's current market value, which is $40,000. That leaves you on the hook for the remaining $15,000. You have to pay the bank 5 figures for a car that is currently sitting at a junkyard. Gap insurance pays that $50,000 difference for you. Now, gap insurance itself isn't a scam. The concept is actually great. It can save you from absolute financial ruin. It is highly recommended if you fall into one of these categories. You put little or no money down. If you didn't make a big down payment, your loan balance is definitely going to be higher than the car's value from day one. Sellfy.com says that the average new car buyer puts only 10% down as of 2025, which is half the recommended 20% down payment. And without going into too much detail, and because we all live in different states, be cognizant that some of us pay, let's say, between 7 and 8% in sales tax. For a $50,000 purchase, over $3,800 goes to sales tax alone. Therefore, a 20% down payment looks more like $13,800 down payment instead of $10,000 to account for sales tax. You have a really long loan term. If you finance your vehicle for 72 to 84 months, you're paying off the principal very slowly, meaning that you're underwater on the loan for years. Bankrate.com says that in the third quarter of 2025, the average new car loan was 69.07 months, way above the recommended 48-month loan. Combining a lower down payment with a longer loan term creates a recipe for being underwater for longer during your vehicle ownership. Not to mention, if you have a high interest rate, very little of your monthly payment goes towards the principal during the first couple of years. You rolled over negative equity. If you traded in a car that you still owe money on and added that debt to your new car, you absolutely need gap. So if it's so helpful, why do I say it's a ripoff? Because of where and how you buy it. When that finance manager offers you gap insurance, they're usually charging you a flat fee of anywhere between $500 to $1,000. And worse, they'll roll that cost right into your car loan. That means that you're paying 5, 6, 7, or even 8% interest on that $1,000 for the next 6 years. You end up paying way more than the sticker price. Because think about it, you're financing add-ons that don't allow you to stay above water on your debt. So for the bank, it's the gift that keeps on giving. For gap insurance costing $1,000 over a 6-year car financing term, you could pay around $300 in interest alone, which is on top of an already overpriced product. Here's a secret they don't want you to know. You can usually buy the same exact coverage from your regular auto insurance company for about $20 to $40 a year. Yes, you heard that right. A few bucks a month added to your regular auto policy versus $1,000 financed at the dealership. I was you at some point, and I just opted to buy gap insurance during the vehicle purchase from the dealership because it's convenient and it barely affects the monthly payment. Also, when I started buying new cars, there weren't videos like this one on YouTube. But once I figured out that my own insurance provider offers the same coverage for $1 and change per month, I felt like kicking myself in the butt. If I remember correctly, even my credit union offers gap insurance when you finance the vehicle with them. The second reason I believe that it's often a ripoff is that dealerships try to sell it to people who don't even need it. If you put 20% down on your car, you probably have plenty of equity. Your loan balance is already lower than the car's value. You don't have a gap to insure, but they'll still look at you in the eye and try to sell it to you anyways. And listen, the last thing I want you to do is opt out of it, get in an accident, and be on the hook for a lot of money. But gap coverage kicks in only in very particular situations. You're upside down on your loan and have a total loss on your vehicle. When was the last time you were in this predicament? So here's the regular Joe verdict. You put a big chunk of cash down, skip gap entirely. You don't need it. If you put zero down and took out a long loan, you do need it. But when the finance guy offers it to you, politely say, no thanks. Then call your auto insurance provider and add it to your policy for the price of a lottery ticket. Oh, and this is the pro tip. Once you paid off your loan enough that you owe less on the car than it's worth, call your insurance company and cancel the gap coverage. You don't need it and you don't have to pay forever. I know these types of videos don't bring me a lot of views, but I felt that it was necessary to bring you this topic because many people don't know their options or are new to gap insurance. It feels nice to know that someone out there saved over $1,000 for listening to this video. Don't let the finance office intimidate you. Know your numbers, know your options, and I'll see you in the next video.